Well, let's start with the dot-com crash, because this seems to be what investors are comparing today's market to the most. Like, for those unaware, this was caused by a frenzy of speculation for internet-related companies throughout the late 1990s, because the internet was going to be the future, right? Well, the reality was that people were throwing money at companies that were incredibly unprofitable. And when that was unsustainable, they eventually collapsed, wiping out most of their value. In fact, if you were in tech stocks at the time, you would have lost, on average, 78%, and it would have taken nearly 2 decades to recover. Now, even though 1999 does seem eerily similar to what we're seeing today, believe it or not, back then, the Nasdaq's price-to-earnings ratio was as high as 75, compared to today's of just 35. The largest tech stock of 2001 became Cisco, which peaked at a value of 472 times earnings, compared to Nvidia's 57 times earnings. And even though today's numbers certainly feel like a bubble, compared to back then, it's really not as bad. However, even though Nvidia isn't quite as stretched as Cisco was back in 2001, as it turns out, investors are now beginning to throw money back into companies that still don't make a profit. Case in point, this MIT study which found that 95% of companies saw no measurable ROI with AI. All of this means that, just like the early 2000s, we're starting to see a divergence between investment and productivity return, where investors believe that free money is coming back, and it's better to get in now than get left behind and have to pay more in the future.